Alright guys, today I'm going to do another unscripted video about what I think is going on with the markets and where I think we're going to be headed from here. Recently I did put out a video saying that I didn't think the Fed was going to be doing a pivot, and it looks like from what we saw at their Jackson Hole symposium that they're not going to be doing a pivot after all. It is true that we got a 0% month-over-month inflation for July, and it did look a little bit bullish, and I guess people thought that the Fed was going to be starting to pivot or at least pause their rate hikes because inflation might be starting to come down or had possibly peaked already. But just 1 month of 0% inflation month over month doesn't mean that we're in a downtrend for inflation overall. Let's go ahead and see what Jerome had to say at his Jackson Hole meeting, and then we'll get into what I think is going to be happening here going forward with the Fed rate hikes and how I think that's going to be affecting the stock market and cryptocurrency.
Today, my remarks will be shorter, my focus narrower, and my message more direct.
I think he wanted to be short and direct because people were seemingly getting all of the things he was saying confused and trying to find hidden meanings in it, thinking that we were going to be seeing him pivot and then we could start going to the moon again. But he just wanted to be direct because, as you could see over the past month or so, the market was getting a little bit ahead of itself, and he wanted to bring that down and nip it in the bud before inflation started to rise again, and what he's been doing up until this point was pretty much nullified.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal.
He just said that they want to bring down inflation back to a 2% goal, and the question is really if they're going to be able to get it down to a 2% goal, or if they're going to have to actually admit defeat and start to lower rates again with inflation being sustained at about 4 or 5%. If that's the case, then they will raise the long-term inflation goal target, and that would pretty much mean that we can go to the moon again, but that wouldn't be good for the future of our country or just for the global economy, because while it would be good for us that are invested in cryptocurrency and have hard assets, it would be bad for pretty much everybody who's too poor to actually invest their money and who needs that money to basically pay for day-to-day expenses. So even if it does cause a little bit more pain here in the meantime, I think that it is really an honorable goal and something that they really should stick to get inflation down to 2%, because that's what's going to make life really the most livable and reduce human suffering for Americans and pretty much probably everybody around the world. Because if inflation continues to go up here, that's going to make things go pretty crazy around the world as well. And with us having the global reserve currency, it's just not going to be a good look if we start seeing hyperinflation and the Fed can't do anything about it.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them.
Exactly.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth.
He didn't say a recession, but that's what he meant by a sustained period of lower growth. If you ask me, I would say that there's pretty much two options for why they're saying we're not in a recession right now. It's because they either want to save the terminology for what's coming so they don't have to change it from a recession to a depression or something even worse. And if we're already in a recession, then what are they going to call it whenever things really hit the fan? And the other option is really that they're just trying to deny that we're going to be in a recession the whole time, so that whenever the market does start to go back up and inflation subsides, they can say that it's a soft landing because we never actually saw a recession, just because they lied that we weren't in a recession in the first place. I think, though, that if they admitted that we were in a recession, then it could cause people to start saving money because they think things are going to be cheaper in the future. Also, if they think they're going to be possibly losing their job due to the recession that we are already in, then they could start saving money, and that could bring down inflation as well. But until we actually start to see that they admit that we are in a recession, and this is a good sign with them admitting that we're going to be seeing some sustained slower growth, I think we could continue to see inflation be a real problem just because people think that we're seeing inflation and we're not in a recession yet. And like everybody always says, inflation is largely a psychological problem.
Moreover, there will very likely be some softening of labor market conditions.
That means a recession.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
Also, with unemployment being at historical lows, I think it's going to be a while until unemployment does get to a level that they have to start worrying about that as one of the mandates that they have to control. Right now, they're not actually having to do anything to try to control the unemployment rate because it is within their mandate of having it under 5%. So I think that this means they might continue raising rates, or at least they're not going to start lowering rates until unemployment does start to get higher, and then they have to start taking action to bring it down because it reaches a level that they have to take action due to the mandate.
These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum.
And that's true because they are working on delayed data, and people say that it takes about 6 to 9 months for their rate hikes to actually affect the economy, or for the effects that it's having on the economy to show up in the numbers. So that means that they are probably going to continue raising these rates, and they're going to think that the economy is strong, like I said in one of my previous videos, and that's going to break the market. And then whenever they finally start to get those numbers in, then maybe we can start seeing them pivot. But until then, the numbers are showing them that the economy is really strong and the labor market is super strong, with unemployment being at historical lows. And that means that they have a lot of work to do to bring inflation down. And we're probably not going to be seeing any kind of pivot until either unemployment does start to rise, or we start to see inflation coming down and looking like it's going to be headed towards 2%.
Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
Bingo.
We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
This is what I've been saying for months. While everybody was saying that we were going back into the bull market and that the Fed was going to be pivoting sometime soon, I've been telling you that I don't think they're going to be pivoting until they start to see things actually coming down or heading towards a level of sustainable disinflation, if you will. This doesn't mean that inflation has to come down to 2% before they pivot, but it has to look like it's headed that way. And I would think that it would have to be sustainably below about 4 or 5% for a couple months before we start to see them changing their tune. Unless, like I said, unemployment comes up to an unsustainable level and it gets higher than their mandate. And that means that they're going to be having two things to worry about, and we'll see which one they pick.
At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run.
What was that again?
To 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run.
So that means that it looks like they've gotten the rate hikes to a level that they want to be within in the long term. That means that if we do start to see a sharp downturn in the economy, then possibly we'll start to see them do pauses, but that doesn't mean that we're going to see them do a pivot yet. A pivot is actually whenever they start to lower rates, and we'll get into that here a little bit more in a couple moments.
In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting.
It could be, but that doesn't mean that it's going to be, and if we do see inflation possibly come in at 0 or even less than that percentage in the next month-over-month reading, then maybe we will see them do a pause, or maybe we'll start to see them do 50% rate hikes and basically lowering the rate hikes that they're doing month-over-month. Possibly that means that the 75 basis point rate hike that we saw last month is going to be the peak of the rate hikes that we see. We just have to actually find out what's going to be happening with the economy and if the inflation readings do start to decelerate from here. Fortunately, though, it does sound like if we do start to see inflation coming down, or we at least don't start to see hotter readings month over month, then possibly they are within the range of the rate hikes that they want to be at in the end, and that means that they might not have to raise them very much further than they are right now.
At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases.
That's good news. That's what we want to hear, but that doesn't mean that they have that planned right now or that they have a date set for when they are going to be doing that. That just means, which is pretty much obvious, that they are going to be lowering rates in the future eventually. Everybody knows that already because we don't expect them to keep hiking rates indefinitely into the future forever, obviously.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
That was really important as well because, like I said, they might pause, but that means they're going to have to keep the levels at a restrictive level, because if they do lower rates too soon, then we could see inflation come spiking back like it did in the 70s, and that's something that they've obviously learned from and they don't want to repeat.
The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored.
Now, that was possibly even the most important thing that he said in this whole speech. He definitely can't start to sound dovish right now, because if inflation is starting to peak and he sounds dovish, then it's going to start going back up again. He needs to remain sounding hawkish so that people will expect him to be hawkish and that inflation will be coming down in the future. Like I said, inflation, while it is a monetary phenomenon, it is also a psychological phenomenon. And if people think that he's going to continue being aggressive and raise rates, even if he's going to be pausing or lowering them in the possible foreseeable future, he needs to remain sounding the way that he is now, because if inflation starts to rise again, then it's going to make all of the steps he's taken up until this point basically pointless, and he's going to have to start raising rates again and put another shock into the market.
If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will.
Very important.
Fortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households.
Jerome has to remain sounding very hawkish, because if he does start to sound dovish right now, then inflation will come back, and then he's going to have a lot more work to do. Right here we have the federal funds rate in these red bars versus the S&P 500 indicated by this blue line. And as you can see through this thing jumping around over and over again, whenever we do reach the top of a market right here usually, and we start to see the S&P 500 declining, this means that we are generally headed for a recession. And whenever the Fed sees the S&P 500 dumping like this, generally they start to pause their rate hikes, as you can see by the red bars leveling off here. But then even after they do start pausing their rate hikes, as you can see, the market continues to take a dump and we enter a recession indicated by this gray bar, if you can see it right here. Now you might be thinking, if the Fed pausing rates is going to supposedly make us go shooting off back to the moon again, then why did the market continue to go down? Well, I think that's because of the earnings going down. Like I said, the Fed runs on delayed data, and you don't actually start to see the economy, you don't actually start to see the numbers coming in from the economic destruction that they're causing from these rate hikes going on right now until about 9 months in the future. And whenever that happens, then you start to see people getting laid off, and then they have less money, and then you start to see that taking effect in the earnings, and the stocks start to take more of a tumble as a result of that. As you can see indicated right here by the 5-year break-even, it does look like we're starting to see the expectations of inflation going down into the future, because this is basically a future indicator of people's expectations of inflation. Also, as you know, we do have a severely inverted yield curve, and that usually does indicate that we have a recession on the way, but like I said, we probably are in a recession already, because a recession is technically 2 negative consecutive quarters of GDP, and I don't care what they say. As you can see, going back the past couple of recessions, whenever we did start to see the recession officially be announced, they started cutting those interest rates, and that's whenever we started to see really the second leg of the bear market. Recently, there's been a lot of announcements of really big companies like Tesla here laying off their employees, and this is usually what happens in the middle of a recession, or at least at the beginning of one. Whenever all of these economic data points start to come in and the Fed sees that actually their rate hikes are starting to take an effect and are starting to cause a deep and harsher recession than they think that we're currently in, then hopefully we are going to see them pivot, and then they will start to lower interest rates. But then from what I've said in this video, you might be saying, what does that matter? Because as you could see obviously by this chart back here, whenever they do start to lower interest rates, that doesn't mean that we're in for a short-term spike or a recovery and next leg into the next bull market. That just means that we're in for the earnings recession. Well, guess what Bitcoin doesn't have, and really none of crypto has? Earnings. So that means that hopefully whenever people are starting to look for a safer investment or somewhere to actually find gains whenever earnings from big companies in the stock market are going down, hopefully they'll start to look into crypto, because while it might not be going into the next leg of the bull market, hopefully it will be holding strong and finding a floor while the rest of the market takes the earnings leg down. I really hope that this has been kind of easy to follow, because while it is just the ramblings of a maniac, I think that I might be coming on to something here, because I haven't heard anybody talk about how Bitcoin doesn't have earnings. I have seen Michael Burry put out tweets saying that we're in for a really big next leg of the bear market and that earnings are going to cause another big tumble in the stock market. But I think that Bitcoin, while it is probably going to be affected by the sentiment of the stock market falling, hopefully it's not going to be seeing as much downward pressure, because it's not going to be seeing negative numbers in earnings, because obviously it doesn't have that. Additionally, we've been seeing really big companies like BlackRock, which is actually really legendary, coming into the markets. And this means that whenever the bull market does return, I think it's going to be possibly even hitting actual institutional adoption level and possibly even mainstream adoption level as well. And that means that we might be seeing the worst bear market right now, like the dot-com bubble, and then the biggest bull market of all time, basically, for cryptocurrency after this, just like whenever the internet actually gained mainstream adoption after the dot-com bubble popped. Finally, I just wanted to point out this nupal over here, which I heard a lot of people talking about in the bull market, but I haven't seen anybody really talk about it since we hit the bear market. But as you can see, we did briefly hit this euphoria and greed section up here, and we pretty much just bounced off of that before getting rejected and coming back down for the bear market. Looking back at previous bull markets, you can see that we pretty much don't spend very much time up here in the euphoria and greed section, and once we get there, that's usually a good indication to sell and get ready for the bear market. And likewise, whenever we get down here into capitulation, which we actually are currently in at this moment, we don't spend very much time, but we might come deep down into it. It looks like over the past few bear markets we've been seeing diminishing bearishness, you could say, I guess, and it hasn't been dipping down as far into the capitulation area over time. And if this does hold true for this bear market, then that means that we could possibly even be seeing the bottom of this dip. But regardless of if this continues to dip into the capitulation zone, it doesn't usually spend very much time over here, and I think that it does always represent a very good buying opportunity and a great place to accumulate and get ready for the next bull market for life-changing gains. Like I said, we could continue to dip down here into the capitulation area, but I think that as long as this is in the capitulation zone, it's going to be a great opportunity for me personally to be buying, and I'm going to be taking advantage of that as much as I can. As a bonus point, I wanted to point out that this is a bearish wedge that we saw for Bitcoin over the last month or so, and the price target for that is usually the bottom of the wedge, and that does perfectly coincide with this orange line that we're looking like we're bouncing off of right now at this very moment, and that actually is the previous all-time high from the 2017 bull market. So if we do actually bounce here and turn this into support, then it could be a higher low here, and that could indicate that we're forming hopefully a solid floor and that we won't actually bounce here and go shooting straight up, but we'll continue to trade sideways, and it's going to be a really great opportunity to accumulate. If we do, however, come down below here and make a lower low, then it is possible that we're going to be making a little bit more dumpiness. But in the meantime, I'm going to be keeping a good eye on this $20,000 range, because this is the previous all-time high from a previous bear market, and I think it's going to be significant going forward one way or another, if it is support or if it's resistance. I'd really love to know what you guys think in the comments of my theory on Bitcoin and cryptocurrency being spared of the next leg down due to the earnings declining in the stock market. Thank you guys so much for watching. I hope you have a wonderful day, and I'll see you guys next time. Bye.